maybe a couple of months more. I do think we're going to get a test. The test might be middle of January, it might not be. But I don't think we're looking at a cataclysmic fall off the cliff. This is also an election year cycle. So that's sort of the wind behind the bulls. You have a lot of stuff that's going right. Powell does not have to cut. He just doesn't have to raise again. He's got to cut at a certain point, but I think that cut's going to take place probably mid-year, where we start to cut.
Not in March, because there is a thought that it's going to happen as early as March.
Yeah, and the reason why I think it's mid-year versus March is that they have to stop QT, and I think they're slated to stop QT in June or so. So that would line up, or else it would just confuse the markets, cutting on one, raising on the other.
All right, Bonawyn, if you take a look at the narrative around whether or not the things have been pulled forward, what do you think? Are we already giving up some of those gains because we've gotten them already in the last 2 months?
Well, I think it falls into two different buckets. So in terms of earnings expectations and earnings growth, I'm not sure that's necessarily been pulled forward. We really didn't have much earnings growth this year. And so looking for 10, 12, maybe slightly higher earnings growth, I think perhaps, that's pretty reasonable. What I do think has been pulled forward, however, is the rate story. Sorry, Steve, we're usually seeing eye to eye on a lot of these things. In this one, I think I'm on the reverse of your reverse. So, I think, the March cuts are priced in terms of the Fed fund cycle. And it's not just about whether or not they cut. It's about the extent of cuts. And as some of our guests, have mentioned, this may be 75 to 125 bips overdone. So I think that has been pulled forward. And so the macro setup, I think, is
I
a bit
agree
too
with
rosy.
him.
I'm not really sure.
And
we
I
have
think he
much
makes
wiggle room
most
for anything
sense.
to go wrong, for consumer spending to
I
slow
see
down,
the end of March, like what
for
Bono's
housing
saying.
prices to have any type of hiccups, or for mortgage rates to back up. So all of those things, you've seen credit card balances over $1 trillion. So I think any type of shakeup in the consumer backdrop might create, and the rate backdrop might create hiccups and challenges and headwinds for us in 2024.
Julie, what's interesting about that macro backdrop is the rate cutting expectation is what arguably has powered a lot of the small cap move in the last 2 or 3 months of the year. Do you think that the small caps still need that rate cutting narrative to continue
Of
to
course.
try to play catch up with the large caps?
It's just begun.
Yeah, absolutely. You need that to happen in order for those to kind of maintain that they always have a little bit of a gap to a large cap, but you really want to have some kind of tailwind in terms of interest rates to kind of support these businesses. And it's pretty dependent on the soft landing as well. Most of them are pretty cyclical, pretty sensitive. You can find very high quality businesses in this space, but if you want to be an investor broadly in small cap, you better hope that everything goes right. I agree with Bonawyn. Expectations are really high. If there is any kind of bobble, I think the market could have a pretty severe correction.
Carter, have there been any signs of iffiness in the market?
So let's talk about the concept of pull forward, right? That only applies to the S&P, perhaps up 24%. If you look at the Russell 2000, to Julie's point, small caps have lagged. It's up only 15% year-to-date.
This guy
so
knows
there's
his
not a lot of
stuff.
pull forward. Or consider this, the Russell 3000, where it represents 98% of the investable capital in the United States, the median stock was up 8. So what pull forward? It's just the big names that have driven so much. In fact, of the 11 sectors in the S&P, only 3 outperform the market. So it's pulled forward in certain areas, but a whole lot of other things are not pulled forward at all.
Now, does that set you up for this catch-up trade everywhere else in the market besides the Magnificent Seven or the top 10 in the S&P?
Right. So the real question is, let's take the Russell 2000. All stocks added up are basically the same market cap as about Apple. Right, so little money is required to move the bottom 2,000. I definitely think that's the play. If one had to do one simple, are you overweight or underweight, small versus large, I would go with small.
Steve, what do you think? Is this one of those scenarios where it's going to be large versus small all over again in 2024?
I don't know. I battle with that because we've had it's difficult. I think you can have the Russell outperform for certain amounts of time, but I don't think that's going to be the theme because with passive investing, there's so much money that's drawn to those larger cap names that you can't help push those names forward and leave the others behind. But when you look at the Russell, 40% of the Russell 2000 is unprofitable. So to Julie's point, you need rates to stay low for them to have an equal shot, a bite at the bull, if you will. So I don't know if that's going to be the theme for the year. We saw when the regional banks collapsed back in 2023, which is earlier on. What was it in?
The key
in
is the
spring of it,
banks,
basically?
if they loan money.
We saw
If the
the
banks
safe
don't
haven
loan
trade.
money, the
And
smalls
then
are out
we
of the
saw
game.
the growth trade. So it's the tech is large cap tech is the trade for all seasons. So I think it will always be there. Maybe the Russell can have a little bit of a day in the sun, but I don't think it's a theme.
The interest rate complex is always going to be a focus because of the way it influences valuations. I wonder, Bonawyn, if you take a look at the valuations of the market right now, there are those who believe that the market is trading at the average forward price to earnings multiple it has over the last 5 years, so it's fairly valued. Others say that you got to look at the interest rate picture as well. Is the market fundamentally valued?
I would say it's fully valued, certainly. I think around 19, maybe 19 and a quarter times. I don't think you can argue that it's undervalued by any stretch of the imagination. I think you can, like the other panelists have said, there are pockets, that 19 times is a blend. So there are certainly pockets that are quite expensive. If we're looking at the Apples of the world, for example, within that Magnificent Seven, I think that's very different than looking at some of the banks, for example, that are trading at 8 times, for example. So I just don't think it's a monolithic situation. In terms of the S&P historical average, sure, over 5 years or so, or 3 to 5 years, 19 times seems to be in line. Over a longer period of time, I would argue that's on the rich side.
All right, Julie, any signs of stress right now that you're seeing in credit markets that would lead you to believe that we are due for some kind of a pause or a downturn in the next several months?
For sure, anyone who has variable rate interest debt, so auto, those guys have seen more delinquencies rising. Mortgage is still quite stable, but that's because everyone locked in really low rates. So I think that is the place to kind of keep paying attention to on the health of the consumer. And then obviously the office market is the place that we're all really worried about how that's gonna pan out.
And of course, we're in an office building right now, guys. Our next guest is out with a new note today saying that the markets could kick off 2024